hopefully get a conversation going. So be thinking of your questions. Okay.
Good morning, everyone. My name is Paul Hanley, and today I'm going to be talking to you about the issue of changing labour markets post-COVID and their impact on the length of time that it takes to replace a worker in a job. So this is a joint paper by myself and Dr. Marta Ortega-Ortega. And I'm just going to start off with a small bit of background to this paper in terms of the post-COVID environment. So as we know, post-COVID, there was a very large impact on the labour markets across Europe, and the European economy, and Ireland in particular, is where this paper is focusing. And post-COVID, what we saw was a tightening of labour markets, which coincided with declining unemployment rates and increasing job vacancy rates. This can have an impact on the length of time that it takes to replace a worker who becomes ill. And this is the key focus of this paper here. So I just want to start off with the key definitions that I'll be using in the presentation. The first one is the friction period itself. So I come at it from a health economics background. And when we talk about the friction period, we talk about the time from the onset of worker absence due to an illness until a replacement has been recruited, generally assumed to be from an unemployed pool, but that can be due to job changes as well, people moving around and covering an individual that has left work due to illness. So the friction period is the length of time when that worker leaves due to illness and when they're replaced. It's dependent on a range of labour market conditions and factors and so on. And prime amongst these would be labour demand and labour supply. And it can be proxied by the unemployment rate, which is the pool of labour supply. They can be proxied by vacancy rates, which is the demand for labour, the amount of jobs that are available. And then the core feature here that I'm going to be looking at is how can we match these two together? If we have labour supply in terms of jobs available, if we have labour demand in terms of an unemployed pool, how quickly can we match those job seekers to jobs in the economy? And we know that this matching efficiency changes over time due to changing structural dynamics in the labour force. So we know that something as wide-ranging as COVID can have a large impact on how jobs are actually matched in the economy. And we know that in macroeconomic theory, we know that these can alter over time, that vacancy durations, matching efficiency, they're all linked to the underlying economic conditions. So this study then aims to examine the extent to which COVID and post-COVID in particular impacted on these friction periods that we've defined, how quickly workers are replaced in the labour force. So this is a before and after. How quickly were workers replaced before COVID? And what impact and potentially does it have a permanent impact on labour market dynamics after COVID? So this is the key focus of this paper. Just a small bit of background then in terms of the theory that's used and some of the other key variables that are used. So the underlying model that I use here is called the DMP model, and that looks at labour tightness and turnover and the pressure on wages and so on. In terms of this paper here, the key aspect of the theory suggests that there's an inverse relationship between labour market tightness and this friction period, the length of time to replace a worker. So as labour markets get tighter, as unemployment rates reduce, we tend to see it being a longer time to replace a worker when there's a vacancy. So an inverse relationship between tightness in a labour market and that friction period itself. Some of the terms and some of the data that I'm going to show you assess those labour market dynamics post-COVID. And what they refer to is two main things. One of them is mismatches in the labour force. In economics, we tend to call that structural unemployment. And structural unemployment is when you do have vacancies out there, but the skill set in the economy, the skill set of the workers isn't matched to that. And so we have a structural dynamic in there. We have unemployment, even though there's jobs available. The other aspect that I'll comment on is the unemployment gap, or what we tend to call in economics cyclical unemployment. Cyclical happens over time due to differences in labor demand and labor supply linked into a business cycle. So we've got two different types of unemployment there, and both of them have an impact on how long it takes to replace a worker. Generally, a rising mismatch rate and a narrowing unemployment gap indicate an increased length of time to replace a worker. So that's what this study tries to test empirically. Does that indeed happen? And did it happen in the post-COVID environment? So the first piece of evidence, or the first piece of data that I'd like to show you, is in terms of that unemployment gap, what we would term that cyclical unemployment, difference between labor demand and labor supply. So what you see is that around the financial crisis, around 2010, 2011, these rates, these unemployment gaps, cyclical unemployment was very high. We see it decreasing over the entire period up to the outbreak of COVID, and we see a relatively small COVID impact around cyclical or the unemployment gap. We do see unemployment rates increase for the first year, but then decrease thereafter. So very little impact in the post-COVID environment around cyclical unemployment, very little permanent impact. Where we do see it, however, is in the next slide, which is the matching efficiency, the skills match. And this is, anecdotally what we would have heard at the time as well, that, there are jobs out there, but the sectors that are being affected, these people aren't skilled for those other sectors where the jobs are. So the structural unemployment, you can see the largest impact from COVID on that, the matching failure rate. So what we see post-COVID is that there was an increase in that matching failure rate. We had jobs open in one sector, but there wasn't the skill set necessarily in the labor market to take up those jobs. So we saw it increase, and in many cases it didn't decrease, except this here is showing across Europe. So we're showing different European regions, but I've also put Ireland onto that map. And what we see in Ireland is a slightly different story. The matching failure rate actually decreased post-COVID in Ireland. So we were a bit different than most people. We had the initial same impact, but then it decreased thereafter. So the biggest effect of COVID was around matching efficiency. Diverse skill sets, jobs available, but the skill sets not joined together. So that's one of the biggest impacts. Then the third diagram in this set, and the final one, shows that friction period itself. So how long it's taking to fill a job after a worker is absent with illness. And what you see there is a very clear impact of COVID across the European economy, across all 4 regions, but also in the Irish economy as well. So what we see in that case is an increase in the friction period. It's taking more time to fill a job because that matching efficiency, the efficiency of matching labor demand with labor supply has declined. And in that case, it had quite a substantial effect, particularly in Western Europe. And what I've done is I've mapped out the actual quantitative impact of that. So we can see it visually there, but in addition to that, we have the actual figures here. So Central Eastern Europe, we saw there was 18 more days in the post-COVID environment to match a person with a vacant job, the exact same time in Northern Europe, but even larger time frames in Southern and Western. So 38 and 39 days more when a job becomes vacant to actually match that with someone who has the equivalent skill set. So COVID had a big impact on the duration that job vacancies are open. And we can see in Ireland, not so much compared to our European partners. So what I have done in this study here is to assess that with a formal model. just to see if the figures we're seeing here stack up from a statistical significance perspective. Is this indeed a statistically significant finding, and what's driving this? So what I did was I took as many countries as I could across Europe, 27 European countries. A few of them listed there were excluded due to data discrepancies and non-standardized data. But I built up an annual data panel data set of 20 European countries, 27. The data sources are coming mainly from Eurostat, and they're looking at job vacancies, the unemployment rate, and I've put in a few control variables as well around GDP and inflation. So a range of macroeconomic variables, mainly concentrating on the labor market. And what I did was I devised a regression that would assess what we're just after looking at there. In order to calculate the dependent variable, what I did was I calculated the vacancy duration based on a standard formula out in the literature. That standard formula looks at flows of vacancies and stocks, divides one by the other, and multiply it by 365. So this is how we actually get that vacancy duration, how long a job is open for. So that's the dependent variable. That's what we're trying to explain, how long vacancies are open for. And what you'll see in the next slide is the model itself. So what are the explanatory variables? What's causing that? So the first model was pretty much a basic model with no controls in it. So a very almost correlation-based model where we have vacancy duration as the dependent, and we have the unemployment rate as a proxy for labor market tightness. So how tight a labor market is depends on the unemployment rate. So we look at unemployment rate, we look at a dummy variable for post-COVID. So we try and target in on the COVID impact, and then we look at the sensitivity of the friction period or the vacancy to unemployment changes. How sensitive is it over time? Did COVID change the sensitivity? The second model that I'm going to show you is almost identical. The only difference is I put in some macro control variables because things such as GDP and inflation and the type of labor market, whether it's temporary or permanent workers in the main, they can impact on these relationships. So I've added on there 3 control variables: GDP, inflation, and temporary workforce. But it's essentially the exact same regression model that's here. So what I want you to show you today was the impact, the result of this model. So if I flick to the results, we're going to see that, and I'll just pick out a few. In model 1, the most basic one with no controls, what we see is with the variable, it looks at post-COVID. So what's happening in the labor market post-COVID only? What we see is a result of 22. What that means is after COVID, there was an extra 22 days to fill a vacancy compared to before COVID. So an extra 22 days to match up skill sets where there was existing jobs, there was labor demand, but they had to be matched together. So COVID delayed the filling of vacancies by on average 22 days. And even when we put in the control variables, that finding is quite robust. It's almost 22 again, even with the controls put in there. So we can say for definite that COVID did lengthen the time to match up labor demand and labor supply. We can also see a negative relationship between unemployment and the vacancy duration. So that follows theory. As the unemployment rate falls and the labor market gets tighter, the vacancy duration is increasing. It's taken longer to fill a job. So the model fits in terms of theory. It's fitting in terms of significance as well, because both findings were significant. And what it also shows you here in the minus 1.1, and that's just really a comparator to the previous one, it shows that not only is it taking longer to fill a vacancy, but minus 1.1 tells you that the sensitivity of the vacancy duration is higher when it comes to unemployment changes. So what does that mean in English? It means when you have a tighter labor market, the vacancy duration increases and is more sensitive to that tightness. Okay, the controls then, only one of the controls came up as significant, and that was GDP. And that just tells us that as economies grow and there's more jobs available, it gets a small bit slower to fill those vacancies. It's a positive relationship there. So the key thing here is that it's a robust model across both of them, even with controls. You're getting the same findings essentially, and they're reaching statistical significance as well. And they're the different statistical significance levels that we have here. So pretty robust model when it comes to macroeconomic data, and some key findings in there that I just want to summarize now. So the key findings then are that the friction period or the vacancy duration did increase substantially post-COVID in the majority of European regions and even in the Irish case. But not only that, we can see that 22 days was the increase on average. So it delayed the amount of time it took to fill a work post that was open, but also that a 1% tightening of the labor market increased that vacancy duration by 1 day. So each percentage point of tightening led to an increase in the vacancy duration of roughly 1 day. And we saw that that sensitivity increased over time. So just the last diagram to show you, that shows the actual sensitivity of unemployment and the friction period. Basically, we've got a blue line here, which tells you that as labor markets tightened, as we move to the left of the x-axis, the vacancy duration was at a certain level. And post-COVID, the red line, we see that as the labor market tightens, the unemployment rate is higher. So what we're suggesting here is that there was actually a permanent impact of COVID on the economy. And that permanent impact is that it's increased vacancy duration regardless of the level of unemployment. So vacancy duration has increased regardless, i.e. it's a labor market now that is not as efficient. It's not matching labor demand and labor supply as well as it used to in the pre-COVID period. Okay, so that's it from me. Thanks a million for listening. And that remaining one there is something